It's 1:30 p.m. That means it's time for update from the world of business right here on Channels Television. The program is Business Incorporated, and here's what we have for you today. We'll give you updates from the Energy Congress, which is ongoing, day 2 at the United Arab Emirates. A very sad report that more than 84% of government workers in Kenya are depressed. And the price war going on around cement in Nigeria. We'll take a look at that, some of the factors driving it, and what to expect. It's Business Incorporated. I'm Ini John Mekwa. We head straight into the market. That's how we do it right here at Business Incorporated. And it's a good one for Nigeria as we see a recovery at the NGX, 0.59%. That's what we have at intraday. Hope to be better. We had this prediction during business morning, you know, and then it's at 66,775.44. This is the 63rd anniversary number, if I may say so. And then we go to Egypt. It's red right there, 1.12%. Kenya is, however, positive, 0.34%. That's how it closed on Monday. We go to the Middle East now and see what's happening with markets there. Beginning with Abu Dhabi, it's positive right there, 0.53% at 9,839.09. Dubai is also positive, almost 0.5%, 4,201.84. We look at other markets in that region. Saudi Arabia is on the flip side, 0.17%, and also go back to the positive Qatar, 0.16% at intraday. Let's head to London now and see what's happening there. Looks like they have a bit of good news. Teniola stands in for Juliana this afternoon. Teniola, good afternoon. I see some smiles should be on your face at this time because food prices have dropped for the first time in 2 years.
Aini, yes, definitely good news. But, you know, as you know, anything can change the trend. The annual reading of 9.9% in September is down from 11.5% in August, which is a significant drop, and it's encouraging, especially leading up to the festive period. So really good news for customers. The drop was driven mostly by fierce competition that we've been seeing between supermarkets. We have shops like Waitrose and Sainsbury's have been cutting selected prices on items such as dairy goods, fish and vegetables, and they bid to win or retain customers. The good news for customers is analysts expect the prices to continue to fall over the rest of the year. But of course, like with everything, there are still, you know, many risks to this trend, like high interest rates, climbing oil prices, as well as the supply chain disruption from the war in Ukraine. So the hope is that, you know, this is sustainable, but we have to keep those risks at the back of our minds as they could easily reverse the trend. But for now, I think a lot of people are happy and encouraged, Ini.
Yeah, I knew you have that smile on your face. Well, I hope people don't stock too much, you know, because anticipating that prices may change. But let's see if this smile spreads to the markets.
Yeah, you know, despite UK food prices falling month on month in September for the first time in 2 years, the markets are muted today with the index trading lower, around 0.04%. At intraday, the FTSE 100 is also down at 0.4%, while the domestic markets, the FTSE 250, is down also by 0.63. In the currencies market, not so good as well. The British pound hit a 6-and-a-month low against the US dollar this morning, amid expectations that the Bank of England might be done with interest rate rises. It's currently trading down against the US dollar by 0.18%, as well as the euro and Japanese yen, both by 0.12%. Ini.
All right, not looking so good there, Teniola. Thank you so much from the market, and take care of you.
Thanks.
So we move to Europe now, where it's also not good news from there. Germany's industrial production sank to the lowest level in more than 3 years, and that's according to a survey by S&P Global, and it's the sharpest decline since May 2020. Chiponda joins us now. Chiponda Chimbelu joins us now to tell us why he thinks Germany's industrial production is shrinking at this accelerated rate. Hi, Chip. Good afternoon.
Thanks for having me. Well, the main reason for the sharp decline is that German industry is getting fewer orders. That is what has led industrial production to shrink in September at a level comparable to May 2020, when, of course, we were in the initial months of the COVID-19 pandemic. But, of course, there are other reasons as well. Trends both here in Germany and abroad are contributing to what we're seeing. If we look at what is happening in Germany, that includes high energy prices, aging infrastructure, insufficient digitalization, bureaucracy, and a lack of skilled workers. Now, all of these are factors that industry has been pointing to, and it is mostly the small and medium-sized firms that are affected by these trends. They are the backbone of the German economy, and they are struggling to cope with the current economic climate. Meanwhile, they also rely on foreign buyers for most of their business, and the global economic outlook has worsened, especially for China. The world's second biggest economy also happens to be one of Germany's largest trading partners. So all of that doesn't bode well for the economy here, and neither does the recent rise in oil prices, which of course may raise supply chain costs.
So how does this affect or compare to other parts of Europe?
Well, it is worth noting that German industry has been lower than the euro area average in 7 of the last 10 quarters. And of course, that is hurting the wider economy. Germany's economic growth stagnated in the second quarter, and it is forecast to decline 0.4% this year. It is the only major European economy that is expected to contract. That is why some are now calling it the sick man of Europe. But while the picture for the rest of Europe isn't as gloomy, it isn't an upbeat one either. The European Commission expects the 27 EU members, EU economies to grow an average of 0.8%. Now, that is 2 basis points lower than the Commission's forecast of 1% in May. High inflation has affected domestic consumption across the bloc, and it is hurting European economies more than was initially expected. So it is a downbeat forecast for Europe too, and it just so happens that Germany's outlook is worse. There is still some positive news to look at in Germany, depending on how you read it. Some analysts say that Germany's latest industrial production data may be an indication that the end to the decline is in sight, and they are pointing to the slower rate in the decline of orders. They say that that could be a sign that we're set to hit a bottom.
Wow. What about the markets? I hope that's not down there too.
Well, it is worth noting that German industry has been lower than the euro area average in 7 of the last 10 quarters. And of course, that is hurting the wider economy. Germany's economic growth stagnated in the second quarter, and it is forecast to decline 0.4% this year. It is the only major European economy that is expected to contract. That is why some are now calling it the sick man of Europe. But while the picture for the rest of Europe isn't as gloomy, it isn't an upbeat one either. The European Commission expects the 27 EU members, EU economies to grow an average of 0.8%. Now, that is 2 basis points lower than the Commission's forecast of 1% in May. High inflation has affected domestic consumption across the bloc, and it is hurting European economies more than was initially expected. So it is a downbeat forecast for Europe too, and it just so happens that Germany's outlook is worse. There is still some positive news to look at in Germany, depending on how you read it. Some analysts say that Germany's latest industrial production data may be an indication that the end to the decline is in sight, and they are pointing to the slower rate in the decline of orders. They say that that could be a sign that we're set to hit a bottom.
All right, Chip, thank you so much for that update from Germany. Now let's move to the United States, where stock futures turned down as traders kept an eye on rising Treasury yields Dow Jones Industrial Average Futures declined about 141 points. Let's look there. That's it. It's 0.24% at 33,556 point. The S&P futures is 0.29%, also in the negative, 4,312.25. Nasdaq 0.24% in the negative. The 10-year Treasury yield traded at 4,739%, hitting its highest level since 2007. The benchmark yield has surged in the past month as traders assess the possibility of tighter Federal Reserve for longer. Wall Street is coming off a mixed session after lawmakers in Washington arrived at a short-term agreement over the weekend that headed off a government shutdown. The 30-stock Dow closed lower, 0.2%, while the S&P 500 closed marginally higher. Nasdaq Composite rose for a fourth day in a row. In Asia now, Hong Kong stocks led Asia-Pacific markets low on Tuesday in their return from a National Day holiday, which was on Monday. The city's benchmark Hang Seng Index closed 2.69% lower, 17,331.22, recovering slightly from earlier in the session when it was down more than 3%. In Australia, the S&P AX 200 traded down 1.28% to close at 6,943.4 after the central bank held rates at 4.10% as expected by a poll. In Japan, the Nikkei 225 dropped 1.54% to close at 31,237.94. South Korean and Chinese markets are closed for holiday today. A global oil space now, prices lowered in earlier trade after falling to a 3-week low in the previous session on a stronger U.S. dollar, a darkening global macroeconomic outlook, and mixed supply signals. Brent futures lost 61 cents to $90.10 a barrel, while U.S. West Texas Intermediate crude edged 50 cents lower to $88.32 a barrel. Earlier in the session, prices fell by more than 1%. The U.S. dollar on Monday rose to a 10-month high against a basket of major pairs after the U.S. government avoided a partial shutdown and economic data fueled expectations that the Federal Reserve will keep rates higher for longer, which could slow economic growth. In the metals market now, gold extended losses today, hitting a 7-month low as expectations around the Federal Reserve keeping rates high boosted the dollar and bond yields, while focus turned to U.S. job openings, which is due data that's due later on today. Spot gold was down 0.1% at $1,825.50 per ounce, dropping to its lowest since March the 9th. Bullion was down for a 7th consecutive session. U.S. gold futures shed 0.3% to $1,841.80. The dollar climbed to over a 10-month peak, while Treasury yields hung near 16-year highs after data on Monday showed U.S. manufacturing took a step further towards a recovery in September. Welcome back. Still watching Business Incorporated here on Channels Television. Well, in Nigeria, there's a price war between cement manufacturers. One of them has reduced its price by 57.14% to $3,500, but that is not at the retail point. At the retail point, the price is still $5,500. So we have the announcement from a cement giant saying that they've slashed prices to $3,000, about $3,000, but it's still selling at $5,500 at the retail. Given that cement is a major building material used by construction companies, well, what's the implication? Well, I had some colleagues saying it's time to build their homes since cement prices have been slashed, but what are they seeing at the retail prices? But let's talk to analysts with financial derivatives company now. Halima Adedinro joins us virtually from Victoria Island. Hi, Halima. Good afternoon. So tell us exactly what's happening from your discovery or your research. We heard of price slash of cement, and then, I mean, what's going on at the retail? How much of that price slash has sipped down to consumers?
Okay, so thank you for having me. By structure, the cement industry is just like the telecommunications industry. It is oligopolistic in structure. And so we have few producers and many buyers. And in this cement industry, we have the dominant player, which is Dangote Cement, and two leading players too, which are Bois and Lafarge Cement. So this price slash is a strategy used by a player in the market. They either use the price or their output. But for this case, Bois is using the price to penetrate the market, mainly because one, they are projecting to increase their output because they have a new operation line which is about to start operation very soon. And so because of this projected increase in supply, they are trying to penetrate the market through price in order to drive up their demand. But we need to look at another aspect, which is their market share. What is their market share compared to their other competitors? We'll see that their market share is low compared to the dominant player. And even if the new line starts operation, their output will be at about 17 million tons, which is far lesser than the total market demand for cement in Nigeria. So which means there will still be demand that needed to be fulfilled in that space, which could drive up price. That is on one aspect of it. While the flip side is if one of the market players, so to speak, the dominant player, decides to go that route of price reduction too, and it now eventually reduces it more than 33,500, which Bois cement is expected to be sold now. We will see that there will be a crash in price and consumers will tilt to Dangote cement as well. So there is, in all of this, what I could say is that consumer would really benefit in terms of consumer surplus. And we cannot really say it will have an immediate impact because there are still some buyer and some retailers that have the old stock. They will need to sell them off before they can restock and sell at the new price. But presently, the price is still 5,500. And to buttress the inflation, the impact on inflation, that would have to do with what is the weight of cement in the total inflation basket. That will go a long way to determine if actually it will trickle down to reducing the inflationary pressure in the country or not.
All right, Halima, you kind of touched on the question I wanted to ask, which is how much of that price cut has gotten to the consumer. And Halima, you're not supposed to mention the name of brands right here because, I mean, so if you be more conscious of that. But you talked about market share and all of that. Don't you think that eventually the brand that has the lower price will claim more market share?
Because the way the structure of the market is, the dominant player normally determines the price, while others that are price market leaders follow suit because of their capacity in terms of production and in terms of cost per unit. So it's more easier for a market, the dominant player, to play with price than the market, than the price taker in an oligopolistic market. So we are likely to see that, and that could cause a more market rift kind of in the industry.
Yeah, well, a dominant player today might be kicked off that table tomorrow if, you know, price. But also, I believe there's also the factor of quality for consumers, not just price.
Yes, not only the price. Yes. So, but in terms of quality, based on the few research I've done, they are both of good quality, but it's just that there are slight differences in them, which consumers wouldn't mind to tilt to the product with lower price, given that they are already strained when it comes to income and their level of acceptance of price increase. Consumers are resistant now when it comes to price hike. So they go for products or commodities with lower price.
Okay, all right. So price is king right now with all the macroeconomic windfalls that are hitting Nigerians and other members of the world. But thank you so much for sharing your research with us, Halima Adediran, analyst with Financial Derivatives Company.
Thank you for having me.
All right, we move over now to what's going on in Abu Dhabi. It's day 2 of the Abu Dhabi International Progressive Energy Congress. We learned our own Minister of State for Petroleum is supposed to be there by tomorrow. The conversations that fuel prices that consumers pay at the pump will be driven by a willingness to keep investing in fossil fuels. Well, the exhibition, which is to advance decarbonizing today's energy system and to collaborate on the energy system of tomorrow, is hosted by the President of the United Arab Emirates, His Highness Sheikh Mohammed bin Zayed Al Nahyan, and hosted by ADNOC at the Abu Dhabi National Exhibition Center. That's ADNEC. Well, speaking at the ADIPEC Energy Industry event in Abu Dhabi, the Minister Suhail Al-Mazuri said that OPEC Plus producer group cares that the price is right for consumers, but right for the consumers is in a very limited time only, and that's short-sighted. He notes that more investment is needed in oil and gas for prices to be right at the pump. That's one of the conversations going on even as we speak in Abu Dhabi. Now, away from Abu Dhabi, but still talking oil and gas, Egypt, which faces growing demand for gas from its population of 105 million, will resume liquefied natural gas exports this month as planned. This was disclosed by the Petroleum Minister, Tariq El Molla, who said that the government is still preparing for that, as quantities are not yet defined. Egypt's LNG terminals on the Mediterranean coast have the capacity to ship 12 million metric tons per annum, a figure the country aims to reach in 2025, making it a major LNG exporter. But high domestic consumption prevented the most populous Arab country from exporting any quantities in June. Egypt has been trying to position itself as a regional energy hub, selling its own gas and re-exporting Israeli gas as LNG to the Middle East, Africa, and Europe. However, the country faced power cuts in the summer, and its natural gas production has fallen to a 3-year low. Mueller said that he expected the power cuts to ease, but did not give a firm date. Rapid growth in Egypt's natural gas supplies boosted the discovery of the Mediterranean's largest field, turned it from a net importer to an exporter in late 2018. Its natural gas exports reached a record 8 million tons in 2022. This year, exports are expected to be 7.5 million tons, with the majority destined for Europe and Turkey, and the rest for Asia from Egypt. We go to Kenya now, where that's not so good news. Kenya Public Service Commission Chairperson, Mr. Anthony Muchiri, has expressed concern over the increasing number of civil servants undergoing depression. Appearing before the National Dialogue Commission, Mr. Muchiri said that depression among civil servants increased by 84% in the last 3 years. The chair submitted that data from the State Department for Public Service showed that more public workers sought psychosocial support in the financial year 2022-2023 compared to 2018-2019. Mr. Muchiri further submitted that most public servants' pay slips are overwhelmed by taxes and mortgages, making it extremely difficult for them to meet basic needs. According to the Public Service Payroll Management System, 17,132 out of 79,253 public service officers earn less than a third of their net pay, representing 21%. Additionally, 13,661 of the 31,892 prison workers take home less than a third of their salary. The chairman notes that most officers are servicing mortgages through the Civil Servant Housing Scheme and other non-public schemes, thus affecting their disposable income and resulting in low quality of life. Well, that's the much we can take. Not so good news from Kenya. We hope something is done about their mental health right there. That's it on Business Incorporated today. Thank you so much for being a part of it. I'm Ini John. Enjoy the rest of the day.